Coming up on the program, Afrexim president says success of AfCFTA depends on Africa's ability to combat corruption. Abu Dhabi's $710 billion sovereign wealth fund looks to Africa and renewable energy to generate greater returns. And South African economy grows in the third quarter of 2020 as GDP increases by 13.5%. Many thanks for joining us on Business Incorporated. I am Bisi Adebayo. Let's kickstart the show as usual with market numbers, which were mostly negative in Africa at intraday. South Africa's GSE lost the most by 0.43%, while the NSC in Nigeria sustained Monday's negative sentiment and was down 0.08% at intraday. On the flip side, though, the Egypt's EGX30 was up 0.1%, and Kenya closed negative on Monday. But it's a different picture in the Gulf region, where investor sentiments appeared mixed at intraday. In the UAE, both indexes were in positive territory. Dubai's main index jumped 2%, while the Abu Dhabi market rose 0.4%. Now, elsewhere in the region, the Qatari index shaved up 0.7%, while Saudi Arabia's main index declined 0.31%. And in Europe, stocks opened lower today as talks between the UK and the EU continue to yield little progress as time is fast running out to agree on a deal. Chelsea Delany tells us more, and she joins us live from the Frankfurt Stock Exchange. Good afternoon, Chelsea. Investors are watching Brexit negotiations closely as British Prime Minister Boris Johnson heads to Brussels to try to break the stalemate on a trade deal. But how are the markets in Europe reacting?
Well, investors seem to be taking this in stride for now. There has been a bit of pressure on stock markets, both here in Europe and also in the UK. The DAX here in Frankfurt is down about 0.5%. But I would say that investors still, for the most part, are hopeful that the UK and the EU will be able to reach a deal. We've heard many warnings over the past 4.5 years since the vote was decided, just how catastrophic this would be for the economy, for many businesses. It could lead to hundreds of thousands of lost jobs, of business closures. So I think investors really hope that that will drive the two sides together to strike a deal. But the comments we've been hearing from both sides have been pretty negative. Boris Johnson, the UK Prime Minister, discussed today at a hospital visit just how many tricky issues they're still negotiating on, and he mentioned that there could come a time where they need to really call it quits on these talks. I think investors haven't yet taken that to heart. So if we do see the UK leaving without a deal, if these negotiations do fall apart for the last time, I think we would see a much bigger shakeout in markets. Some investors and analysts think that we could see the British pound fall to parity with the euro. That would imply another 10% decline for the British currency. So I think there would still be a lot more damage on markets if we don't see a deal coming out of these talks.
Meanwhile, Pfizer has warned U.S. officials it won't be able to supply a substantial amount of its COVID-19 vaccine until next summer. So will this delay vaccine rollouts and the reopening of economies?
For the U.S., this would certainly pose a problem to the timeline that has been proposed by U.S. President Donald Trump. The U.S. has secured about 100 million dosages by the end of March. They're supposed to be getting that delivery after they approve the vaccine. They haven't done that yet, but they are expected to approve the vaccine potentially this week. 100 million doses is enough to vaccinate about 50 million people, but of course that's not nearly enough to really make a dent for the U.S. But now Pfizer is saying that the U.S. might not be able to get any access to more dosages until later on in the summer. That would really be a problem for the U.S. as they hope to reopen. But it's not just the U.S. We're seeing a lot of supply constraints already across the world. There has been obviously a huge race to secure access to these vaccines, especially the ones that are front runners, the ones that have been really leading the race. Many countries have struck these deals, but there will be a limited supply for the next several months. Pfizer and BioNTech actually had to reduce the amount of vaccines dosages they expect to supply to about half of their previous forecast for this year because they are facing constraints in their supply chain. They're having trouble getting enough raw materials. We've heard many reports about there not being enough dry ice to ship this vaccine. So there will be more hurdles and more challenges as we go forward with this really enormous logistical and distributional challenge.
All right, finally, Chelsea, Europe's tech sector has received a record $41 billion in investment this year despite the COVID-19 pandemic. What's driving this increase?
This is a bit of a surprise. This is a banner year for European tech investment, despite the pandemic and all of the uncertainty that's really created for business and especially for smaller businesses, for younger businesses. Despite that, EU tech businesses have brought in about $41 billion worth of venture capital funding this year. And we've seen in particular a lot of investment from other countries, from investors in the United States, from investors in Asia. And this is really a big step for Europe. It's really a milestone because the EU and businesses in Europe have really been criticized for lagging behind the tech scenes in Asia and China and the United States. EU has really been seen as the laggard in terms of tech startups, in terms of the digital economy. So the fact that we are starting to see more demand, more interest in EU tech businesses, and also we're starting to see more businesses like Spotify, like Klarna, the Swedish financial technology app, they are starting to really become much bigger players in the game. So this is just another sign of how the EU is starting to catch up to these more advanced and more developed tech scenes across the world.
Thank you, Chelsea. We'll see you again tomorrow. Well, let's get to know how the markets are performing at intraday in the UK as Brexit negotiations continue. And Juliana Olayinka will be telling us about that and more. Good afternoon, Juliana. It's good to have you back. Now, what's the latest regarding Brexit talks? Any sound bites coming from PM Boris Johnson's trip to Brussels to break the stalemate on a trade deal?
Well, it's difficult, Bissy. There is so much movers and shakers on both sides of the channel. Boris Johnson last night made a high-stakes gamble and has decided to take over negotiations, and he's expected to arrive in Brussels anytime soon. We haven't heard from Downing Street on when that will be. It's unlikely to be today because, of course, he's doing so many hospital rounds as we look at this monumental, historic Pfizer inoculation that's currently taking place in England. Tomorrow, there is an EU summit, which Boris Johnson won't want to disturb. So we're expecting it to be potentially tomorrow night or on Thursday. But who knows? Everything now is all to play for. This is a high-stakes gamble. The negotiations have been going on for 3.5 years. A couple of weeks ago, Michel Barnier, the EU's chief negotiator, was forced into self-isolation. And according to the Times newspaper, during that time, Ursula von der Leyen, the European Commission president, took over talks and was apparently too soft on Britain. She, of course, is a German politician, a really senior German politician. And because of those negotiations, there's a huge row that's currently taking place between France, Emmanuel Macron, who wants to be much harder on Britain. Everybody knows France and Britain have a historic love-hate relationship. And Angela Merkel, Germany obviously being the strongest economic powerhouse in the EU. So at the moment, there appears to be distress amongst the EU 27. And of course, in Britain themselves, Britain have, of course, voted to leave the European Union. There are so many positions and MPs are not happy on both sides. Of course, there are the hardline Brexiteers who do not want Britain to concede. They do not want Britain to give any more of its sovereignty away to Europe, especially on the lines of fisheries. Now, fisheries, believe it or not, is the main sticking point. Britain have abundant fishing waters around the Isles. France, in particular, want a full access to these fishing waters, apparently up to 10 years after Britain leaves at the end of this year. Boris Johnson not giving in to that absolutely not so whatsoever. So hardline Brexiteers really don't want Boris Johnson to concede. But of course, you know, COVID-19 has absolutely crippled the British economy, more so because we're a service-based economy than our European counterparts. Can Britain survive crashing out of the EU after our economy is so low? That is the conundrum that Boris Johnson is currently facing. So I've been saying this for the past couple of months, but it does really feel that this week, this meeting with Ursula von der Leyen will be the last ditch attempt. And whatever happens, we know it's going to be a hard Brexit in the next couple of weeks. But will it be a hard Brexit with or without a deal? Nobody knows yet.
We'll just have to wait to find out. Now, Christmas is already just a few weeks away, and the UK grocery sales have hit a record as Christmas spending starts early. I guess the supermarkets are finally making up for lost times. Now, how's that coming?
Well, last month, it was illegal for anybody to eat and drink outside of their homes, at least in England, because we were in a month-long national lockdown. And during that time, people have been stocking up on lots of food and groceries. And year on year, supermarket sales have increased by 13.9%. £10.9 billion was spent in the big grocers. And of course, there has been lots of controversy around supermarkets because unlike other non-essential retailers, they were allowed to stay open, which is why we saw over the past couple of weeks a lot of the big four, particularly Tesco, Sainsbury's, Morrison's, Aldi and Lidl, they have given back their business rates to the tune of over £1 billion because they were still giving out dividends to shareholders, and a lot of the non-essential retailers weren't happy. They were still able to trade, still able to sell clothes and non-essential goods when all of the other retailers had to close their stores. There are expectations that this month of December will see much more sales. I think a lot of economists are predicting that Britons will spend £1 billion more than they did last year. And of course, as well, e-commerce is a major part of that. I believe last month, 6 million Brits spent money online with online grocery sales, more than they did last year.
All right. So how are the markets reacting to all of these at intraday?
Not a great day on the FTSE. They did have some gains in the morning, but they've lost some of that, mainly to do with oil. Oil prices are particularly down. Some of the big oil giants, BP, Royal Dutch Shell, their shares are down 0.9%. And that's because there's renewed lockdowns in Germany, renewed lockdowns in California and South Korea. That's spooking investors. The FTSE All-Share at intraday is down 0.36%. The FTSE 100 down 0.46%. And the FTSE 250 down by 0.16%. In currencies, no-deal Brexit is really spooking investors. The pound down on the US dollar by 0.19%, down on the euro by 0.28%, and down on the Japanese yen by 0.16% at intraday, Bissy.
Thank you, Juliana. We'll see you again tomorrow. Do enjoy the rest of your day.
Thank you.
Now, the markets in Asia traded mixed on Tuesday as investors remain cautious over rising coronavirus cases, the U.S. stimulus negotiations, as well as Brexit talks between the UK and the European Union. Japan's Nikkei Asia 25 fell 0.3% to 26,467.08, while the Topix index was down 0.11%. In South Korea, the Kospi was down 1.62%, and Australia's benchmark ASX 200 gained 0.19%. In Hong Kong, the Hang Seng index was also down 0.72%. And U.S. stock futures fell earlier Tuesday as traders kept an eye on negotiations for additional fiscal stimulus, while the U.S. coronavirus caseload continues to rise. Dow Jones Industrial Average futures declined, just as the S&P 500 futures and the Nasdaq 100 futures also posted losses. Away from those numbers now, the president of the African Export Bank and Import Bank, Professor Oke Orama, says the success of the African Continental Free Trade Area partly depends on the ability of the continent to stem the tide of corruption and illicit financial flows. Professor Orama explains that stopping illicit capital flights will cut by half the annual financing gap of $200 billion that the African continent faces as it strives to attain attain the Sustainability Development Goals. The Afrexim president, who made this known at the virtual 2020 Africa Business Ethics Conference, noted that between 2000 and 2015, the total illicit capital flight from Africa amounted to $836 billion compared to Africa's total external debt stock of $707 billion in 2015. When we return in just a moment, we'll be talking commodities. Do you stay with us? Welcome back. Abu Dhabi's top sovereign wealth fund is looking to Africa and renewable energy to generate greater returns while relying more on artificial intelligence to mine data and spot new investment opportunities. The $710 billion fund, known as ADIA, this year started a climate change equity portfolio aimed at boosting its green economy exposure and is a shareholder in sustainable energy projects that generate more than 20 gigawatts of power. Now, copper is one of the most resilient of metals used for several purposes. Its price on the mercantile exchange is now at a 7-year high of 7,760.50 per ton, signifying a 25% increase in the year 2020 alone. Now, that's the focus of our conversation today on the commodities market segment. And I'm being joined by a research analyst at the financial derivatives company, Seyi Omidiore. Good afternoon, and thank you for joining us on the program. Now, tell us, what is responsible for this spike in the price of copper, especially in the midst of a pandemic?
Thank you very much. Now, commodities prices as a whole are deemed leading economic indicators. Now, the prices of metals have also increased during this time frame. Now, copper in particular has gone on this bullish run as a result of a number of factors. One being an increase in the manufacturing numbers coming out of China. Now, China in and of itself has a global demand of about 50%. That's an incredibly high number for the global demand. Now, China is expected to increase its numbers through the year, and it's expected to hit all record highs of about 4.4 million tons by the end of the year. Also, another factor that has driven the demand for copper is our hopes of renewable energy sources. Now, electric vehicles have about 3 times more copper than there are in internal combustion engines. With the pandemic, world governments are looking to quickly transition now from fossil fuels into renewable energy. And that is why the demand for copper has also increased sporadically in the last few weeks.
Now, typically, when a commodity price spikes, like what is happening with copper now, it could be followed by a sharp decline. Are you expecting a high level of volatility at that market?
Yes, we are, because historically, when we look at the data available, we see that commodities prices have shown an incredible level of volatility. Now, these numbers are expected to also remain this way. We don't see any change happening in the foreseeable future.
Now, in Nigeria, copper deposits are mainly found in the northwest and the northeast region. But with the insecurity issues in that part of the country, how can Nigeria exploit this mineral?
The simple and short answer to that is we currently can't, because if we look all through what we have, we see that investors typically will not love to deploy their resources into uncertain ventures. And looking at insecurity, we see that it's as insecure as insecurity gets. It's as uncertainty gets. So, of course, unless we actually tackle the problem, which is dealing with the insecurity in these regions, then it is unlikely that we will be able to exploit this mineral and export to use to diversify our revenue base.
All right, research analyst at the financial derivatives company, Seyi Omidiore, thank you for sharing some of your time with us this afternoon.
Thank you very much.
And from South Africa, Statistician General Risenga Maluleke has announced that the country's GDP grew by an annualized rate of 66.1% in the third quarter, or 13.5% year-on-year. Risenga says the increase is as a result of the easing of lockdown restrictions. The manufacturing industry increased at a rate of 210.2% in the third quarter, contributing 16.2% to GDP growth. All 10 manufacturing divisions reported positive growth rates. The mining and quarrying industry increased at a rate of 288.3%. Now, South Africa's GDP fell by 51% in the second quarter of 2020 on an annualized basis.
By 66.1%, seasonally adjusted, annualized. And when we look at the seasonally adjusted, not annualized, it rose by 13.5%, and it has recorded a negative growth 9 months on 9 months, sitting at negative 7.9%, and of course, year on year, sitting at negative 6.0%. Share of GDP compared to the share of employment, we tend to see that generally construction, agriculture, and trade tend to have a larger share of employment all the time compared to their share of nominal GDP. We are saying that all sectors have grown in the third quarter of 2020, with the highest growth having been observed in the primary sector, that's sitting at 172.9%, and of course the secondary sector 155.6%, and tertiary sector sitting at 37.6%. All industries have shown a positive growth. We will remember that in the last quarter, third quarter of 2020, we had seen growth in agriculture, and indeed we had also seen the margins of a zero growth from government. Now, all the sectors had gone on a negative growth. This time, we see that all the sectors, the industries, have grown in the positive.
And that's where we wrap up today's program. Thank you for watching. I am Bisi Adebayo.